Hello, friends. Are you somebody investing into equities? Are you a value investor or maybe a portfolio investor? Or somebody looking forward to do some investments for future? Even if you are not investing, that's perfectly fine. Some or the other point of time in life you will have to do it. So this is going to be very, very important. Today, I will share one of the very important fundamentals of any company that you should be looking at before you put your money at risk. So this is Abhishek Raj, son of two superhumans, my mom and dad, brother of two most caring sisters on the planet, a gardener and a chef by hobby, a computer technician turned quality analyst, now a stockbroker and investment advisor. So today we will talk about debt is to equity ratio. So we'll know three things. Number one, what is debt to equity ratio? Why is it important to look at before you invest into any company, and how it may vary depending upon the industry or the company that you are looking at. So number one, as I said, it's debt is to equity ratio. The formula is very simple. You divide the debts of any company by the equities that the company is holding. Now, when you divide this, let us take an example. There is a company which has got a loan or a debt of, let's say, 100 crores, and it has got equities worth maybe 50 crores. So if I divide 100 crores of debt to its equities of 50 crores, we get a number 2. Now, the notion 2, what it means for, as I gave you the example, 50 crores is the equity, 100 crores is the debt. So what's happening is and the debt is to equity ratio is 2. So what's happening is for every single rupee that the company has in terms of its equity, it has got 2 rupees of debt. So for every 1 rupee, 2 rupees is debt. So I have personally in my company, let's say 100 crore rupees in terms of my equity capital, but I have loans worth maybe 200 crores. So that's what it is. Now, why is it important? Very simple and logical. It gives you an insight of company's credit worthiness. Of course, maybe, for my business expansion, if I go to the bank and tell them, hey, I have got an equity of, let's say, 50 crores, I have debt already of 100 crores, they would not consider me because I have very high debt to equity ratio. I am very leveraged organization. I have taken lots of debt, a debt laden company. On the other hand, let us say if I have an equity of the same 50 crores, but I have credits or maybe debts only to 25 crores. So if I divide 25 to 50, it's 0.5. So for every 1 rupee that I have in my company, my net assets, my cash, my equity, I am only taking 50 paisa debt from the market. So my exposure, my leverage is very less. This gives you an insight of the risk profile of any company that you invest on. So it's a very important fundamental parameter that you should be looking before you put your money at risk, before you invest your interest, before you invest your money. Now, just don't go by the notions or the numbers. Lower the better. At times there could be negative debt to equity ratio. So I would personally suggest stay out of any company with negative debt to equity ratio. It ideally may mean that the company doesn't even, it's a negative net worth company. My total net worth, let's say, it's 100 crores. But if I have a loan or liabilities or debts of maybe 500 crores. So the day if I have to wind up my business, I would be able to give only X amount of money. However, I have burden of, let's say, 2x. So I am a negative company, negative net worth. So stay out of negative debt to equity ratios. Companies are very less, but it may have. So stay out of it. As we understood, what's debt to equity ratio and why is it important? It gives you clarity on the credit worthiness of the company. Plus it gives you the risk profiling as well. Now, don't go by these lines only. You need to be very, very precautious while analyzing any company because it may vary for different organizations, for different industries. So this is how it works. You need to apply some logic. Okay, I'll give you an example. Let's talk about a telecom company. So if I have to, let us say, set up a telecom company, or maybe if I have to expand my business to maybe a remote state into some maybe northern part of India, or it could be some Himalayas region where I don't have my coverage as a telecom company. So I'll have to install towers, I'll have to put in the fiber cables, I have to, lots of resourcing is supposed to be done. So that itself will take maybe 6 months and a year, and then I'll start earning from the revenues that I'm getting from people, from my subscribers. So for a telecom company, the debt to equity ratio would be very high. Similarly, it goes with financials as well. A financial company that's into lending, understand, a lending company doesn't have much of assets. They may have some sort of assets which they have acquired from defaulters. But again, bottom line of an of a lending company is they borrow money and lend it further. So whenever they borrow money, it's a complete debt on them. Then they lend it further, they earn interest, and in case it turns out an NPA, it goes to be completely waste of money. That's an NPA. Now, so before you take your decision, analyze what kind of industry, what kind of sector are you getting into, and then take your decision. It may vary for different organizations, different companies, different industries. So always make a habit of taking an average of the entire industry and see where is the company that you are looking at standing. If let us say debt is to equity ratio of any industry, maybe manufacturing, consumption, utilities, automobiles, construction, whatever it is, okay, let us say the average industry's ratio is let's say 2. So if you are investing into a company with a leverage ratio of 2, or maybe 2.5, or maybe 3, it's fine. 1.5, fine. But in case you have a company that has got, let's say, 6 debt is to equity ratio, it's very risky. Very risky. The company is highly leveraged. Now, one more thing before, when you filter out the companies with high debt is to equity ratio, go deeper and then find out whether is some sort of investment planned. Maybe if I am as a company, I had a debt is to equity ratio of only 2.5, which is well as per the standards of my industry. However, now I am looking at an expansion. I'm looking forward to do some sort of expansion into my business and to do better in terms of my earnings, and my equity holders, my shareholders will earn more from that. So for the time being, for the expansion purpose, of course I'll need to take debt. So this is how you should proceed. If that's the reason why my debt is to equity ratio has gone up, it's fine. You can still invest. It's a growth making company, a company you're looking forward to expand. And because of that expansion process, the debt is to equity ratio is very high. So this is one parameter. I hope this is going to help you a lot while taking your investment decisions. That will be all in this particular session. I'll once again keep sharing great information that is going to help you taking your investment decision. You can always connect with me. We can meet over a Zoom call for 30 minutes, free consultation. We may work it out further. Thank you so much for listening. Abhishek Raj signing off. Stay healthy, stay wealthy.